Let's find some option swing trades. Hello, everyone. It is Wednesday evening, May 27th. It's time for our weekly swing trading video. We've had a little bit of excitement today, had a little bit of a boring week. We had a pre-holiday setup with Memorial Day coming up, so the action really was pretty dull Thursday and Friday. Today, we were actually able to get a couple of our spreads done because we had a market pullback. So, as always, let's start with the market, get our bearings, and then let's look for some trades. You can see that the 100-day and 200-day moving averages have come into play. The market was able to ride that 100-day moving average, and then boom, we spiked right above it yesterday. But the price action was a little bit lame. We saw some selling. Today we tried to rally above that level, and the early action was very, very negative. We fell right back below that 200-day moving average, and that suggested some pretty heavy selling, pretty heavy resistance. So let's zoom into that 5-minute chart and see what's going on. It'll really help us. And we'll go back to yesterday's price action because the gap higher was huge. And here you can see monster gap higher through the 100-day, through the 200-day, above the 300 level on the SPY. But you could see as the day wore on, the bid started to soften. One of the tells was right here when the market couldn't get through this resistance level and it couldn't make a meaningful test of that high of the day. That's when the sellers came in. Had a little bit of a bid, market tried to grind back. Very lackluster trading, very low volume trading. Really wasn't a lot going on. Typically, there's a post-holiday hangover, and that's what we saw. Later in the day, we did take out the low of the day and we started to fill in some of this gap right here. So we did see some selling. This morning, the market again broke out, blew through those two major moving averages, blew through the high of the day from yesterday, but every subsequent candle was red. And we saw some really heavy selling. Now I'm going to tell you a little bit about the market. I'm also going to be covering how to leg out of trades. There are two different time horizons that we need to take into consideration. Are you a day trader or are you a swing trader? And that's different for each type of trader. So we had this market decline right here, and first I'm going to talk about day traders. So if you had some positions on that were problematic, NVIDIA was one of our problems that we had on, you would see this pullback here, and then we had the 1OP indicator, which I'm going to overlay, was telling us that the market was ready to roll over. I'm going to increase that study so that we can see it a little bit better. And here you can see how the market pulled back. And I mentioned in the chat room, I said, listen, folks, we had some really long red candles closing on their low, a little bit of a compression, not much of a bounce here, and then we immediately get right back to the selling pressure right here with the long red candle. As soon as I saw that, I knew we were in trouble. We had a bearish cross. We took out the low of the day. But I was telling everyone in the chat room, I want to leg out of NVIDIA because it has a lot of relative weakness, but I don't want to do it until we take out the market low right here from yesterday. Because then, if we take out that low, I'll know that we've got more market downside and that there's a good likelihood that we'll fill in more of that gap. So, when I saw this red candle, that's when I bought my short put back on NVIDIA, the 340 put, and I watched the market come in, I watched the stock come in, and I was able to exit and leg out of that spread. But because the bid-ask spreads were so dang wide on NVIDIA, it was tough for me to buy back my short put. I had a huge bid-ask spread to overcome, so even with this big decline right here, I was only able to scratch the trade, and it didn't last long. The sell-off did not last long. As soon as we bounced, I saw this 1OP cross right here. I thought, yeah, you know what? I'm not going to let this run away from me. Tried to do a little bit better than a scratch, but that's all I could get out of it, but that was fine. So on a day trading basis, you can leg out of spreads like this, but you have to make sure that you have market impetus working in your favor. And once we took out the prior day's low, and with these long red candles, I felt that we had a good chance to do that. Plus, if I'm going to leg out of a spread, I only want to do it early in the day. I don't want to do it late in the day because then I still have a lot of time throughout the course of the day to try and make money on that long put position. In this market, you have to be very, very careful because the market is in an uptrend. And we're going to get back to that in just a second. So that's how we leg out of trades. You will always, on a bullish put spread, you will always have to buy back your short put first because that will leave you naked long a put, which every brokerage firm is fine with that. But what they will not allow you to do is they will not allow you to sell your long put and then still be naked short a put unless you've got a boatload of money in the account and you can cover the naked margin requirement for a $340 stock like on NVIDIA. So the idea there would be, hey, I still like NVIDIA. When I get this big market sell-off and this bounce, I'm going to sell my long put and I'm going to stay naked short that put. As the stock and the market rebound, I'll be able to eventually buy that short put back at a much lower price. You cannot leg out that way. You always have to leg out by buying back your short position first and then hanging on to the long. But you already know that because we've legged out a 2 call spread successfully in the last week. We've had to buy back our win spread. We were able to do that for a small profit. And in the last week, we were able to buy back our SHAK bearish call spread. We're able to leg out of that and also make money on a losing trade. So it can be done, but it's different for a swing trader. And I'm going to make that distinction right now. So just make sure that if you're doing it on a day trading basis, that you have to have relative weakness in the stock. And let's take a look at NVIDIA right now. Let's take a look at that relative weakness. Here you've got the open. Down, 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 selling super, super hard. Even if we go into the daily chart, we kind of sense that we might have a problem yesterday when we had this bearish engulfing pattern and we closed right here on that 340 level. This morning, it seemed like the whole world fell apart on the stock, especially in the first 5 minutes of trading. And so as the stock was coming in, we'll put up the SPY overlay. You can see how the market found support in here and rallied, but the stock really didn't. And that was a clue that it was going to be headed for some trouble. So as the market started to break down in here, we had some follow through with the stock. And then once it formed that low, it took off. So this is what you have to do. Line up the market with the stock. You can leg out. I typically will try and sell the long put for what I paid for the short put. And so basically I get to keep the credit that I received when I initially put the spread on. That would be profitable. If you can't get that, just try and scratch the trade and sell the long put for the same price as you paid for the short put minus the credit received, and then you'll be able to scratch the trade. But I do not carry this position overnight. If my intent is to leg out of it intraday, then that's what I'm going to do with it. So from a swing trading standpoint, it's a little bit different because you're taking a much longer term perspective and you're looking at this stock on an end of day basis for the most part. So let's go in and let's take a look at what's happening on a daily basis with the market so that I can kind of drive this point home. So I'm going to take off the overlay and I'm going to put up the SPY. And you can see I've drawn an upward sloping trend line here connecting that low and the low here. As long as we have this upward sloping trend line, we have to be long the market. Even though I think the market's a little bit overextended right now, I think that there's a lot of optimism. I think that as we get closer to Q2 earnings, a month and a half from now, that some of the air is going to get let out of the balloon. I think we're setting ourselves up for some disappointment. Every CEO has said, hey, Q2 is going to be much worse than Q1. So we may get some earnings warnings. I also think that the recovery may be a little bit more sluggish than everyone expects right now. But I got to tell you, there's a lot of optimism out there. Everyone seems eager to get their lives back to normal. So there could be a lot of pent-up demand. Consumer spending could be very robust. You've got governments looking to add stimulus. Japan announced a $1.1 trillion stimulus plan. Europe about 800 billion euros. The U.S. we're talking about another stimulus plan. So the central banks are printing money like mad. They're getting engaged in all sorts of quantitative easing. We've got governments also engaging in fiscal stimulus. You have asset managers not wanting to be in fixed income with 0% interest rates. They can't even keep pace with inflation, so they're generating negative real returns in the fixed income market. All of that is forcing people into equities right now. So with this safety net from governments and central banks supporting the market, supporting the economy, they want to be long and they will err on that side. So that's what's fueling the current rally. We've got a couple of tails under body right here. So if you are going to leg out as a swing trader of a spread, first and foremost, as always, market first, market first, market first. So we have a market that is trending higher. So the spreads that you would need to be very, very cautious on as a swing trader would be any kind of bearish call spread that you've sold out of the money. And when would be a great example? And Shack would be a great example. And you can see how the stock was starting to run up and it was starting to break this downward sloping trend line. It was starting to challenge resistance. Casino stocks are very hot. So it was appropriate for us with the market breakout and with it testing the upper end of the range to leg out of that spread. And we do that again by buying the short callback. And then ideally, we're going to try and get out that same day and we're going to try and sell the long call for the same price as we paid for the short call. But if we can't, it's okay to hold that position overnight. Well, why is that? Because we have a market tailwind and the market is trying to move higher and higher. And that's exactly what we had to do with Shack. So last week, Wednesday night, I had mentioned to you, I said, there's the video came out on May 20th. I said, right now, we are going to leg out of this. Is there any danger? No, we still have the 100-day moving average to lean on. We still have horizontal resistance on the stock to lean on. But I want to get out while the going's good. I did not expect the market to test that upper end of the trading range and to try and challenge the 100-day and 200-day moving average. I didn't expect that. I thought that resistance was going to be in place. So once I saw that this was going to be happening and the market was able to hold gains, I knew that we needed to adjust this position. So we had an order out to buy the SHAK calls back, our short calls, and those were the $55 calls, and we had an order to buy those back for $2.40. Well, the next day, we were getting fills at 240, 235, 230, and I mentioned whatever you sold, whatever you paid for those calls, try and sell the out of the money calls for the same price. And I believe those are the 57.50s, and so we were able to sell those right on the open Tuesday morning. Boom, we were out. So we successfully legged out of that spread. So as a swing trader, you want to make sure that you're watching these technical levels and you're watching what's going on in the market. I typically don't like flip-flopping on a position because I've gone instantly from being neutral to slightly bearish on a stock to all of a sudden, now I'm bullish. And I'm bullish in a big way because I'm long premium. So I really don't want to be that exposed for very long. And the only thing that can get me to flip like that is, as I mentioned, a change in the market conditions. And the second thing would be the stock moving through technical resistance. And once that stock moves through technical resistance like this, what happens is our trade was predicated on this 100-day moving average holding. And that is what was going to increase our probability of success. Remember, we sold it back in here when the stock was starting to roll over. It had broken the upward sloping trend line. It was weak relative to the market. All sorts of reasons for us to take this trade. But we felt that if the stock did rally, that this resistance would hold and that the SPY major moving averages would hold. As soon as they gave way, one of our primary reasons for doing the trade was gone. We knew we had to adjust. So because we have that market tailwind and because the stock is starting to grind higher, we could safely buy back that short call. We still had plenty of time left on the trade, so time decay was not going to be an issue right away, so we were able to hold it for an extra day or two and eventually leg out of that spread. And now that the stock has broken through this major resistance level, it will continue to run higher. Could you leg out of the trade and hang on to your long SHA calls. Yes, you could, but as I mentioned earlier, I don't like flip-flopping on a stock. There were reasons that I thought SHAK would struggle. I think the restaurant industry is going to have a very prolonged reopening, and I think they're going to have a tough time making money until they can have full occupancy and full seating. So I would not want to hang on to this and let it run. There are a lot of laggards that are starting to catch a bid right now. So when I have a chance to scratch or make money on what I think is a poor trade or a losing trade, I never pass up that opportunity. I can find better longs right now than SHAK. So that's why I would close it down as a swing trader. Let's take a look at NVIDIA. And that was a trade that I put out Sunday night, and I sent a video out. So what would you do as a swing trader on NVIDIA? Well, again, our premise on NVIDIA was that we need to exit that trade if the stock closes below that 340 level. That was our premise for the whole trade. If you go back and watch the video from Sunday night, I had mentioned to you I thought the market would continue to be strong. I thought the stock would be strong. I felt that this would stay intact. It did not. But as a swing trader, your time horizon is much longer. So you let this intraday noise run its course and you evaluate based on the closing price within the last 10 minutes of trading. Now, if you'd have watched the last 10 minutes of trading on NVIDIA, you would have gone, yuck. Oh boy, that thing was in trouble, but everything's fine. And so many times you'll see a stock intraday drop below one of those major moving averages that we're leaning on and bounce right back. And you scramble, you adjust, you try and get out of the trade, and then at the end of the day when the dust settles, you go, wow, that was a waste of time because that intraday noise shook me out of the position. I really didn't need to do much with it. I would have been perfectly fine if I would have just sat on it. So if you're a swing trader, try and stick with the position and try and stick with that initial technical support level that you've identified. And if that is breached, then you definitely need to get out of the position. If the market conditions had changed, you can get out of the position a little bit earlier. But in the case of the S&P 500, we would have needed to have seen a substantial sell-off and a likely close below that 100-day moving average. Now that would get me to close out some of my other bullish put spreads if I see that happen. A breach below this upward sloping trend line, that could actually get me short at this stage of the game. I don't see that happening right now. I see a lot of enthusiasm. I see a lot of excitement, optimism, a lot of money floating around that's going to try and get the economy kickstarted. So I don't see that happening, but I think we've got to be very, very cautious moving forward. I had to spend some time on how to leg out of bullish put spreads. I don't like to do it very often. And let's take the case of NVIDIA. Let's put that up one more time. Instead of legging out of a spread and taking on a lot of extra risk, if you're a swing trader and we closed below 340 on NVIDIA, just buy it back. Start bidding for the spread. Figure out where you can buy it back. If the bid-ask spreads are super wide, just try and find something in the middle. Try an order, cancel it, place it a little higher, cancel it, place it a little higher until you finally find where they're willing to trade with you. So close it down as a spread, and then you won't have a lot of additional risk exposure, because when you're legging out, things can get very, very ugly. NVIDIA today, if you overstayed your welcome and you were legging out and you bought back your short put in here, you had your head handed to you. In fact, I had a loss today. AMAT was one that I legged out of, and we had this drop in the stock. We had the market rallying like mad. The stock was below a major moving average. We'll go to the daily chart, and you can see the 200-day moving average right there. The stock was below the 200-day moving average, and it wasn't coming off the deck. And I'll show you that right here. So I felt pretty safe about staying short that stock while I was doing my daily video. And there you can see the overlay of the market. Look what the S&P did. Look at the rally that it made all through here, and the stock did absolutely nothing, and it was still below that 200-day moving average. So I took comfort in that, and I thought it's still very, very weak relative to the market. No problem. I'll get my recording done, and then I'll adjust the position. And while I was doing the recording today, whoosh. Well, when I got done recording, I had to take a loss because I knew that the stock had started to rebound. The market looked very, very strong. So legging out in this particular case, it cost me. If I would have just shut the trade down, the damage would not have been nearly as great. So those are the finer points of legging out of bullish put spreads. If you're a swing trader, just watch that level that you initially put the spread on for. Watch that technical support. As long as that support holds throughout the course of the day, you're in fine shape. If that support is breached, then try and exit the spread as a spread and don't leg out. And again, I'm going to reiterate this point one more time because it's so important. Now, the exception to that would be, let's say that it was NVIDIA that was the problem child, and let's say that NVIDIA continued to sell off and it was down on its low and we had the market pulling back and continuing to pull back below this 100-day moving average. So if we had a complete reversal, long red candle closing below the 100-day moving average, and we had NVIDIA closing on its low of the day, and everything looked like it was rolling over, then you could try and leg out of NVIDIA and hold an overnight position with your long puts on NVIDIA. But one little blip below support here or below support here is not enough for me to turn bearish. This market has a full head of steam right now, and it would have taken much more than that. If we had a down day today, closing below the 100-day moving average, then another long red candle closing on its low, something similar to this, that starts to get problematic. Then you could consider it because market conditions are changing and the stock is changing. Let's talk very briefly about what we're seeing in the overall market. I'm going to put up the SPY and then I'm going to do an overlay so you can see I have not hit enter yet, and I'm going to enter QQQ down in the bottom because we're going to do an overlay. Here you can see that tech stocks have run really, really hard, and that's the gray line is the QQQ. Tech stocks have far outperformed the S&P 500. Well, right now, we're getting a little bit of outperformance in the SPY because a lot of the laggards are starting to catch up. And here you can see how the QQQ pulled back and was actually relatively flat when the S&P 500 was moving higher. Why is that? It's because tech stocks right now are getting a little fluffy. They have run really hard. The valuations are getting a bit stretched, and you've got people taking profits in a lot of those tech stocks, and they're rotating that money into some of the laggards. And so some of the stocks that we're seeing rally right now are SHAK. Boeing's been a little bit strong recently. You can see how it's rallying. This is a weak stock. Airlines are going to be dead for a long, long time, and new plane orders are down. But this is what we call the dogs are barking. When you start seeing these laggards rally like this, that tells you that the rally is starting to get a bit stretched. Hotel stocks, department stores, Macy's. Look at that. It's starting to catch a bit in here. I'm going to actually take off the QQQ so that it doesn't get in our way here. But you can see that's a nice breakout through horizontal resistance. Fantastic. Nice long green candles closing on their high, gap higher here. Is it time to buy? If you're a trader, a day trader, you can take advantage of a move like this. As a swing trader, I wouldn't, because I feel that the retail industry and some of these retailers have been closed for 2 months. It's going to be brutal for them to try and get reopened. We still don't know how anxious consumers are going to be to go back in a mall and to go shopping. Don't know that yet. I'm a little skeptical. I think that a lot of the online sales are going to take a bite out of the brick and mortar companies because people have just now gotten really accustomed to buying everything online. So I think that the likes of a Macy's and Kohl's and all the other department stores, boy, I don't want to be long those stocks at all, even though technically this looks like a nice little bounce in here. Perhaps a little short covering bounce up to the 100-day moving average. So the dogs are definitely barking right now, and we're going to try and find some stocks that we can park in that haven't run up super high, where we've still got some decent option premiums that we can sell. So expect a little bit of weakness in tech as we see a rotation out of tech and into some of the cyclical stocks. And again, I'm not going to be going into cyclical stocks this weekend. I think that I've got some really nice plays picked up. And what we're going to do is we're going to go into there we go. We're going to go into this chart right here, and we're going to take a look at all of our open positions and see what's going on. So I had mentioned to you that we were able to successfully leg out of the SHAK position. And there you can see we were short the 55 calls. We were actually short the 57.50 calls. We did that for a 50-cent credit. We legged out of it. It's closed. It was a small winner for us, but really nice because now we've got a trade that would have been in danger. DBX, I'd done this video, I believe, on a Sunday night. We were short the May 22, 21 put and long the 2050 puts for a 10-cent credit. That expired last week. That was a nice one. And we also had this NVAX spread that expired as well for a 20-cent credit. So we had 3 trades that went our way. We had a couple of trades that were going to cancel. We did not get filled on the Twitter trade from last week. And there we're trying to sell the 27.50 put by the 27 put for a dime credit. Couldn't get it done. VLO rallied. Weren't able to get that done. Selling the 56 put, buying the 55 put for a 20-cent credit. So we weren't able to get that. So when you log into the staged order screen, you will not see these trades. So let's go to some of our open positions right now. And I'm going to hit 2 of them right away because this one, RNG, expires May 29th. That's in 2 days. And let's take a look at RNG. That has been a problem child with monstrously wide bid-ask spreads on these options. Folks, I'm not going to do that to you again. Okay, we were locked into this position. We couldn't have legged out of this if we tried. The options had a $3 wide bid-ask spread, so legging out, not even a consideration. I did not expect to see this type of weakness in the stock, but anything that's run hard is getting hit pretty hard right now. This was a nice test for the stock today. It sold off and it rallied all the way back. You can see it closed at 252. We needed to get up to 255. I think that's easy. And I love this bullish hammer today, and I love the rebound in the stock. Look at how persistent that buying pressure was with a close above the prior day's close. So I think that this kind of price action throughout the close of the day is going to help the stock tomorrow. I think we're going to see some follow-through buying on this one tomorrow. So I think we're going to be in good shape. We're not going to close ring down. RNG, it is what it is. Whatever happens, happens with this position. And so we're just going to let it run its course. I will say that we put this on for a 50-cent credit. And if you're nervous about it and you have an opportunity to buy the 55 put in for 50 cents, you can do that. I'm not going to do that for the sake of the track record. I think the stock's going to have a full head of steam. I think it's got an easy $3 or $4 in it over the course of the next couple of days. So we're going to stay the course on this one. And let's see. Let's take a look at another one that we've got on LVGO. And I'll bring this screen back into play here. This one expires on June 19th, so we've got lots of time. We sold the 50 put, bought the 45 put. Let's take a look at that stock. And here you can see it got hit pretty hard today, but it rallied back nicely and closed unchanged. We'll go into that daily chart. And here you can see that it filled the gap today. That filled in that gap. So I think the stock is going to find support here, right at that $50 level, and that was the premise behind the trade. So if you got all freaked out today as a swing trader and you looked at the stock intraday and you went, uh-oh, it's down below $48. I better close this thing down. By the end of the day, you're probably thinking, dang it, I should have been able to stick with this. Well, the market rallied into the close too. So if you'd have looked at the market early in the day, you could have thought, well, this is it. This is the top. We've just broken below the 200-day moving average. We've broken below the prior day low. We've broken the 100-day moving average. Everything's very, very fluid right now. So you just have to wait till the dust settles and see how things close. That's why we use stops on a closing basis. But the fact that this gap has been filled and the stock found support here, I think it's going to continue to grind higher and we'll be just fine. So let's take a look at a couple of other trades. We actually got filled on these today. BYND and FB, we got filled today. I'd mentioned to you last week that we're going to keep all the orders open until the video tonight. Well, we got filled on these two, so let's take a look at what kind of shape we're in on those. I think we got some really nice fills, and this is a good tactic to use in this market right now. You can see this horizontal resistance right here at 130. That was breached. I would like to see BYND get back above that price, but we are all the way down here on the June 5 108 put, and we're leaning on that 200-day moving average, and we're long the 107 put, and we did that for a 20-cent credit. So this trade is actually in very, very nice shape. I love the fact that we've got the 200-day moving average protecting us there. I like the fact that the stock was able to bounce off of its low today. Excuse that. And so I love the price action here. I think we got in at a really good price. And I'm going to put up Facebook. And Facebook, we've got the June 5 215 put, 212.50 put. So right here, we're leaning on that 215 breakout right in there. And you can see how the stock never quite got down to that level. And it started to rally. And we've got a nice close very near the high, a bullish hammer right up in there and above that breakout. So I think we've got a really nice trade on in Facebook as well. So got two nice trades that we were able to get into. And we've also got a number of other trades that we're going to be looking at today. And I'm going to show you those and we'll go knock through those one by one. So these top four are our new trades. Excuse me. Walmart, NVIDIA, Netflix, PXD. Wait a minute. What's NVIDIA doing in here? We already have an NVIDIA spread on. Yeah, we do, but I'm pretty sure that's going to expire worthless. I'm quite confident in it, and I like the stock a lot. So we're going to try and take another bite out of that apple. So I've got Facebook up right now. Let's take a look at Walmart, and let's take a look at why I like it. And if I go into the stock ER, I should be able to bring up the most recent earnings report. Well, in any event, the earnings, same-store sales were up 10%, I believe. Walmart cleaned up during the coronavirus. They were deemed essential. They sell food. People were going in there. They weren't just buying food. They were buying everything. They were buying clothing, you name it, houseware, goods, everything. So Walmart benefited in a major way. And they also did an incredible amount of online sales. Well, you can see 1, 2, 3, 4 tests of this support level right here. You've got two major moving averages coming into play with the 200-day moving average at 118. So I'm sorry about that. I've got something crazy happening with my computer, but we'll be able to work through it. Every time I use this recording software, it seems like I've got issues. But let's go in and take a look at the trade that we want to do. So on Walmart, we want to sell the June 12 118 puts, and we want to buy the June 12 117 puts. So you can see we're safely below that horizontal support and that major moving average at the 200-day moving average. And we're going to go into the June 12 expiration, and we're going to take a look, and we're going to click on the 118 puts, and we're going to click on the 117 puts, and because we've got $1 between the strike prices, we're going to try and get a 20-cent credit for this. And you can see that spread, it's actually a negative 9-cent bid. offered at 66 cents. At 20 cents, we're pretty bid side, meaning I think we've got a decent chance to get that filled. And if we're able to, that's going to represent a 25% return in about 2.5 weeks. So let's go through the trade again. We're selling below this 200-day moving average. We're selling the 118 put, and we're buying the 117 put, and we're doing that for a credit of 20 cents. So let's move on to the next trade. Let's go into the staged order screen. We'll take a look at that. Next on the list is NVIDIA. There we're going to be trying to sell the June 19 300 put and buy the 295 put. And because they're $2.50 between the strike prices, we're going to try and get a 50-cent credit. You can see that that spread is offered at 55 cents. So let's go into trade, and we're going to enter NVIDIA. And we're going to go into the June 19th expiration cycle, and we're going right down to the 300 put. So we're going to sell the 300 put, and we're going to buy the 297.50 put, and we're going to be doing that for a 50-cent credit. Well, why do we like this trade? Let's put the stock up. Let's take a look at why we like it. NVIDIA had an incredible earnings announcement right here. Really, really strong growth. They're involved in so many things with cameras right now. Automated driving is just one of them, so the demand for graphics chips is very, very high. We've been selling puts on NVIDIA since the market crash, and there's how much the stock dropped during the market crash. It barely went down, and even while the market was recovering, it was making a new all-time high. So this stock has an incredible amount of strength. And if we start taking a look at where we might find support on it, you can see this $300 strike price right in here that's right at that horizontal support level. So you've got resistance, breakout, support. I like that $300 price level. I also like the fact that the stock moves a little bit. So if we get a little bit of a washout and the stock pulls back, we'll have a chance to get this spread done. By the way, all the spreads that I'm covering tonight are going to be live until the video next Wednesday. If we need to adjust and the market throws us a curveball and we fall below the major moving averages, then I will send an email alert and we'll cancel those orders, and we'll wait for next Wednesday to try and find some other opportunities. But unless you get an email, we're going to stay the course with these trades. So again, we're trying to sell the NVIDIA $300 put, and we're buying the 297.50 put, and we're doing that for a 50-cent credit. So let's take a look at our next trade. We'll go into the staged order screen, and here you can see Netflix. We're going to sell the June 12 390 put, and we're going to buy the June 12 385 put. There's $5 between the strike prices, so we're going to try and get a dollar credit for that. You can see the spread is 45 cents bid, offered at $1.35. So we've got a chance to get this filled. And let's put the stock up. Let's take a look at it. Then we'll go through the order entry. And here's Netflix. Hey, Pete, what the heck? Look at this. The stock's been selling off. We got kind of a double top forming in here. What are we doing a bullish put spread on this thing for? It doesn't look that strong. Well, here's what I like about it. I love this horizontal resistance right here. I love this breakout in here. I like the fact that we have 1, 2 tests of support even above where we're looking to sell this put spread. And the 390 strike comes into play right there at that horizontal resistance, which is support right now. So I really like this. I think this is a nice solid trade. If the market happens to pull back, if there's a resurgence in coronavirus, Netflix is going to weather the storm. Here's another one where you see a little tiny pullback with the market crash, and then as soon as the market starts to recover a little bit, it zooms to a new all-time high. Earnings were very, very good. So I feel very confident that Netflix is going to be able to hold this nice support level, even if the market gets into trouble. So we'll bring up the trade screen here. And we're going to go to the June 12th expiration, and we're going to look at that 390 put. And there's the 390 put. We're going to be selling that, and we're going to be buying the 385 put. So sell the Netflix June 12 390 put, buy the June 385 put, and we're going to be doing this for a $1 credit. I think we might get filled on this right away. You can see that the spread is 45-cent bid, offered at $1.35. So we probably need a little bit of help from the stock, and maybe with the big market run up that we had today near the close, maybe the market pulls back just a touch tomorrow, and we should be able to get this credit spread done. We have to put up $4 for this in margin. The $5 between the strike prices less the credit received is $4. And if we take a look at the $1 credit and divide it by the $4 in margin that we have to put up, that represents a 25% return. So fits all of the parameters. I like the fact that we're able to get nice and far out of the money. So we sell the 390 put. You can see here we're $30 out of the money on that. 10% of the stock price. So I like that. I think Netflix is a nice, safe little play for us. I'm going to go into staged orders, and let's take a look at the last trade. PXD. This is an energy stock. This is an energy producer. I like PXD. I've been long that from the mid-50s during the market decline. I'm still long that stock. And the reason that I like it is they've got tremendous oil reserves, and I believe that as soon as the economy starts to recover, they're going to be opening their wells back up. They're a low-cost producer in the Permian Basin, and they've got another thing working in their favor, and that is that the pipelines are in place. So over the course of the last few years, they've had lots of oil that they wanted to produce, but there was a glut because they couldn't get it to market. Well, now all those pipelines are in place, so they're going to be cranking up. As soon as the economies start to heat up, oil demand is going to go up. Producers are going to start supplying again, and they will be one of the first to recover. So I like this, and we're going to be looking at the stock here, and we're going to, let me put the stock up first, and then I'll show you the strategy that we're going to be using. I've got an upward sloping trend line that I've drawn here, and it comes in right around that $84, $85 strike level. And so that's what we're going to be using. We're going to try and stick with the June expiration. And you can see how the stock has started to fill in some of this gap here. It's been a very gradual grind higher because a lot of the oil producers, for crying out loud, we had negative oil prices for the first time I've ever seen in my trading history. So the industry is pretty hard hit, but this is a commodity-based company, and commodity prices will start to go up once the economy starts to recover. And PXD being a low-cost producer, that's why I really like it. So we're going to try and leverage this upward sloping trend line right here, and we're going to sell an out of the money bullish put spread. And we're going to go into the June 12th expiration. Notice that I'm trying to stay inside that 2-week window. This is 2 weeks and 2 days. I want to keep these short term because I want to take advantage of that time decay, and I want to give myself an opportunity to reevaluate the market, reevaluate the stock every 2 weeks when these options roll off. And it also allows us to keep working our capital and working our capital. If I've got 4 weeks till expiration, sure, I can distance myself from the price, but I'm going to accumulate 16 positions at one time instead of being able to contain that to maybe 6 or 8 different positions so that we're constantly rolling into different stocks and taking advantage of different opportunities. I'd much prefer to do that. So we're going to be selling the 85 put, and we're going to be buying the $84 put. Whoops, excuse me, wrong strike price. There's the $84 put. And you can see that it's 30-cent credit, but actually it's not. That's a negative 30 cents. So it's negative 30 cents bid, offered at 55. If we can get 20 cents for this, I'm quite happy with it. The stock is about $10 out of the money. I see this $85 support level as holding, and I think that energy stocks are gradually going to start seeing the bid come back to them. So I think this is a nice, safe play. The stock is not too far out of the gate, and I don't believe that we're going to see a huge sell-off in energy stocks here. If anything, I think that we're going to see some buying taking place in the energy sector. Asset managers, hedge funds, private equity are going to be looking to buy some of these companies who are really struggling, some of the producers, and you'll have some of the larger energy producers also looking to buy them. There was even talk at one point that the government might look at buying some of these small energy producers for strategic oil reserve reasons. So I like PXD. I think it's going to do really well. I like it long term as a stock. So it's got some short term issues that it has to get through, but you can see that the grind higher has been very steady and the stock is not super, super volatile. So again, on PXD, we're going to be selling the June 12 85 puts and we're going to be buying the June 12 84 puts, and we're going to be doing that for a 20-cent credit. And all of these you can see in the staged orders, and so you can route them instantly to your broker. Just click submit, and the top 4 will be your new trades for this week. So we'll do a quick market recap and we'll call it a day. I'm going to put up the SPY and I'll show you some of the things that I'm watching for. We've got a couple of bullish hammers in here. We're closing above the 200-day moving average. We closed really, really strong. We closed above 300 easily. And so now I want the market to continue to close above 300. The more time it spends above 300, the more likely we are to see the next leg higher. So we don't want to dip back below it. We want it to stay right in here for another week or so. And then I think we've got a chance to add to those gains. But I am a little suspicious. The higher we go, the more suspicious of the market I am, because I think that really good news is starting to get built in, and I don't know that it's all going to pan out. I still feel that there could be some hiccups and some nervous jitters along the way. So as long as this 200-day moving average holds, as long as the 100-day moving average holds, we also have that as a horizontal resistance level. Lots and lots and lots of support here. And as this starts to extend out by next week, you'll also have this upward sloping trend line come into play, so that will simply add another level of support as well. You have to stay long the market, but I think that you still want to distance yourself from the action by selling out of the money bullish put spreads. Option implied volatilities are still elevated, so selling strategies make sense. And you can see the VXX is at 33 right here, and then that's where it was before the market crash, down around the $12 level. So these premiums still have a ways to go to come in before we can consider buying strategies. That's it for this week. If you're watching this video on YouTube, I release it to the public on Saturday. I record it on Wednesday night so that members have 2 days to try and get into these positions. But you have the advantage by watching it on YouTube of going back and seeing how each one of these picks fared, and that'll give you an idea of the performance. So if you are watching it on YouTube, please make sure to subscribe to my channel and turn on your notifications so that you never miss these videos. I post videos every day. They always have lots of actionable trades in them and a ton of education. I've given you a lot to think about today. How to leg out of bullish put spreads, how to leg out of spreads, credit spreads in general, and what you need to be watching for if you're a day trader or if you're a swing trader, because it's very, very different time horizons that you're working with. I hope that these lessons will help you improve your trading. Thanks so much. Have a good night. We'll see you in the morning. Thank you for watching this YouTube video. I'm Pete Stolzers, and I'm going to keep the trade ideas coming along with lots of education, so make sure to subscribe to the channel and please turn on your notifications so that you never miss another trade. If you like the content, please give it a thumbs up. I've loaded 2 other videos that I think you're really going to enjoy. Stay tuned. We'll see you soon.